What is going on, investors? Hopefully guys are doing well out there. Time to pick up the story of Snowflake, ticker symbol SNOW. This stock has been on a roller coaster ride. It went public right around $250 per share. Shortly thereafter, it was over $400 per share. Then it basically got cut in half, back down to $200. Then it doubled all the way back up to $400 per share. And now here we are again, cut in half, back down to $200 per share. Obviously, this stock has been on a gigantic roller coaster ride. We'll talk about some of the things that are required when you invest in these roller coaster type stocks, some of the strategies you can do to maximize your ability to profit off of these type of stocks. Now, if you're sitting there watching this video, we are going to go through those Q2 earnings. We're going to look at that Q3, also that full year outlook that we got from Snowflake. We'll go through all the revenue numbers, the cash flows, the balance sheet. If you're sitting here watching this video and you have an unrealized loss in this stock or you bought it at a much higher price, don't worry. The vast majority of people that have bought Snowflake stock either lost money or don't have a realized profit on this one. It's very difficult to make a profit on these roller coaster stocks. We'll talk about broadly too. Can this one start to flatten out, maybe be a little bit more predictable from a price perspective? Now, look, what's going on at Snowflake is typical in these kind of high flying, high valuation. We have to remember that in the context of talking about this company's revenues and their lack of profits, we've got a $62 billion market cap. That puts this in towards the top 1% of valuations you see in the stock market. You've got a price to earnings forward of that's 1,211. That's astronomical. I don't need to tell you that. Now, we have revenue in the most recent quarter coming in, that Q2 revenues. These came out on August 24th. That was just a couple of days ago. Wall Street has digested these. Investors have digested this. You had $497 million worth of revenue. We'll come over here and show you that this is just unbelievable growth. We're talking about 82% growth year over year. So that is why you have this massive forward PE. That is why you have this massive market cap. Because look, I don't think anybody's anticipating that they continue 82% growth here on out for the next couple of years. But look, Wall Street is actually projecting 50, 60, 40% growth on this one. If you're growing a business at 40 and 50%, I don't have to tell you, these revenues are quickly going to double. In fact, Wall Street in the year 2025, and actually a little bit before that, in the year 2024, Wall Street has this at a $1 billion run rate on that quarterly revenue. Now, from a yearly perspective, Wall Street has this one towards the 2025, 2026, 2027. We're getting to kind of like $7, $8, $9, $10 billion worth of revenue. Obviously, if this company is able to achieve that, $10 billion worth of revenue at a $62 billion valuation obviously seems a little bit more reasonable, especially if they're able to print profits at that time. Now, let's focus a little bit more on the shorter term. We had that Q3 outlook come in as well. Revenues expected to between $500 and about $505 million for the full year outlook. We're expecting revenues right about that $2 billion mark. So again, from a traditional valuation perspective, wildly overvalued from a price to sales, price to earnings. But I say this all the time on the channel. If all we had to do as investors look at this PE ratio and that would tell us whether to buy, sell, or hold, everybody watching this video would be a multimillionaire. We'd be watching this on our yacht. Obviously, investing slightly more complicated than that. Now, the revenues came in, like we said, $497 million. One of the other reasons why this company has a record high valuation, look, obviously that's that revenue growth, but what it also checks in terms of what investors are looking for and what investors are looking to pay a high multiple for is they have massive gross margins. Look at this. Off this 497 in terms of revenue, we had just $173 million worth of cost there. Look at last year, you had just $106 million. So yes, this grew considerably year over year from 106 to 173 on that cost side, but not nearly as quick as those revenues. So our gross profit off of of $497 million leaves us with $324 million worth of gross profit. Now, that's not the full story. Obviously, we have sales and marketing, we have research and development, and we have general administrative as well. Sales and marketing, look, it went from 182 to 274. That's explosive growth. And obviously, like a lot of software stocks that we look at, cloud stocks, they're spending a lot of marketing up front to hopefully retain these customers over a long period of time. Research and development ticking up a little bit, but not a lot, from 118 to 183. And then finally, you have general administrative. They did a very nice job. Sometimes you see the G&A line really balloon on kind of these early stage growth companies. Not at all. I mean, it was basically flat from 65 million up to just $73 million. I really like that, and I really respect that. But we have to keep in mind, off of $324 million worth of gross profit, we had $531 million of total operating expenses. Last year, we had $366 million. So obviously, those ballooned quite a bit. So we take this 324 and we minus off $531 million worth of expenses, and we get an operating loss here of $207 million. So some things to like: the fact that G&A cost flattened out a little bit, but despite the record 82% growth rate on those revenues, notice that our operating loss actually got worse. It went from 200 million up to about $207 million. But if this is where this company can kind of start to equalize these operating expenses, and if you believe, okay, and quite frankly, if you believe what Wall Street is selling you, if you believe what Snowflake is selling you, well, this company should eventually start to churn a profit. In fact, Wall Street expecting one at a very, very small rate towards the end of this year. Maybe that's a non-GAAP profit, but as we start to look out 2026, 2027, I know that seems like a long ways away, but it comes pretty quick when it comes to Wall Street, as you're always looking forward with these types of stocks. Well, they've got some significant earnings coming down the pipe with this one. So if you believe that, certainly something that this company can grow into. Now, from a cash balance sheet perspective, absolutely sensational. So oftentimes, again, with these early stage companies, it's all about that growth. It's all about that forward guidance and kind of forward revenue estimates. As long as Snowflake can continue to check those boxes on that growth rate, well, this is a stock that could perform relatively well heading into the future. And some of the reasons why is the balance sheet is absolutely crystal perfect, okay? They've got plenty of cash. I mean, they've got tons of cash. They have almost no liabilities. This is almost as clean as you get. So there's nothing to worry about from like kind of a going concern. And can Snowflake continue to scale up this business, continue to suffer losses as well, at least from an operating perspective and a net income perspective? I'll show you as we get to cash flows. Paints a little bit better story, okay? And this is what some investors might be looking at, because after these earnings, this stock is gapped up and it's continued to rally. So some of the reasons why I think is what investors are looking at is these cash flows. So you come down this net loss, you pull down for a 3-month period about a $222 million loss. Last year, about 189. So it's gotten worse from that perspective. But in terms of cash flows, you get to add back in stock-based compensation. I can imagine a lot of you understand that this company is spending a lot and rewarding their executives and their employees with a lot of stock-based compensation. You'd be absolutely right. To the tune of $209 million worth of stock-based compensation in a quarter. Last year, just at $163 million. So folks, off a company that did just south of $500 million worth of revenue, they had over $209 million worth of stock-based compensation. Obviously, that's very dilutive from a shareholder perspective, does put downward pressure on the stock as well, as executives and employees start to see the momentum going down. They see their net worth start to decline. Well, they cut losses and they cash out. So that creates negative pressure on this stock. I would expect this to continue as well. But when it comes to cash flows, we get to add this back in like it doesn't even exist. So we take this $222 million worth of net loss. We get to add back in stuff like this $209 million worth of stock-based compensation. And you actually get positive cash flows over at this company to the tune of $64 million. And it's a big, gigantic improvement over last year. year where you lost about $6 million. So from a cash flow perspective, an operating cash flow perspective, this company is moving very much in the right direction. But again, we have to attribute all of that basically to the fact instead of paying the employees with a lot of cash, they're paying their employees with a lot of stock-based compensation. And I showed you when we came to those operating expenses, over $530 million worth of operating expenses, nearly 209 million of those attributed just to stock-based compensation. So again, if you're an investor that's comfortable with that and comfortable with the fact that Snowflake will have to transition out of that record type stock-based compensation and in some ways in the future shift to more cash-based compensation, that will certainly negatively impact cash flows. But at that point, again, you're buying into the fact you've got this 70, 80, 90% growth rate projected out in this type of company. Now, the rest of the balance sheet, the rest of the cash flows, in this case, about what you'd expect. Look, capitalized internal software, just $6.7 million. Extraordinarily impressive off a company that has $500 million worth of revenue to have just $7 million worth of capitalized software cost in the most recent quarter, just $3.8 million worth of property, plant, and equipment. I mean, this company is printing money. That is why there is so much excitement about this stock. This stock theoretically, okay, on paper, could scale up into like Microsoft-like cash flows, Google-like cash flows. And obviously investors are kind of piling in this one early. But as we talked about from the beginning of the show, this one's been on a roller coaster. So these types of stocks, you need to buy them at the correct price. And if you're in this one for the long run, you kind of have to ignore these large swings. Or I think a better strategy is make sure you have stop losses on this type of investment, just in case it goes on some kind of gigantic roller coaster downtrend. Or in this case, we saw this big kind of elevator shaft down with this stock. You get stopped out of this one. So in the longer term, obviously this stock is still in this epic downdraft, but it is more recently broken out of this one and actually is starting to create, again, in the shorter term, kind of a series of higher lows here. This is exactly what you want to see when your stock makes this epic downdraft. Well, all of a sudden it catches a bid. This could potentially be the bottom. If I were to buy Snowflake today, and I'll talk about if I buy it today, but I would have a stop loss underneath the lows that we made back in June. Doesn't have to be on the dot, but you're looking at about $112, $110 per share. You could drop it down a little bit lower. Maybe you're right at $100 even, or if you think that's a psychological level that would reach some support, maybe just under that, about $95 per share. Now, that is over $100 lower than where the share price is right now. So look, you have to be comfortable with that type of loss or suffering that type of loss just in case. Not every investor would be comfortable with that. Now, from a technical perspective, again, we talked about in the shorter term, we're kind of making higher lows, higher highs. This is exactly what you want. It is actually broken out above kind of this shorter term trend that we're making in. So what I would expect this one to do probably over the next couple of weeks, maybe the next month, is actually pull back into this channel. And this would be your first buying opportunity. Now, we could buy the technical breakout. I think this would be more of a shorter term trade. Longer term investors, I think, should be a little bit patient with this one. Wait till we pull back, maybe reach some support. If this trend line continues to hold, this should be a good buying opportunity. Now, this is not to say if you want 10 shares of Snowflake, that I would buy all 10 here. No, I would probably buy just one or two, because if this line doesn't hold, well, all of a sudden this trend is likely broken and we're probably coming back down to maybe retest these lows down here. I would dip my toe into the snow very, very, very gently, because obviously the price action in this one obviously supports that. Now, on the way up, some of you are like looking at your shares and they keep going up. We should meet some resistance here right about the $220 mark. That has acted as some support in the past. And I think on the way up, look, we're still like $30, $20 from that share price. This one I could see in the shorter term rally up to that mark, meet some resistance, and then maybe turn around and meet some support down here. That's what I see from a technical perspective. This one looks pretty good, But if I were to buy Snowflake stock, I would just be gently buying shares, probably fractions of shares at a time. Again, if you're playing the long game on this one, there's absolutely nothing wrong with just buying little bits of shares, little pieces of this company over time. You don't have to get it at the dead low. On top of that, I would set a stop loss on this one just in case it goes on one of these downdrafts. The other thing that we didn't talk about on today's show, what would cause this stock to lose even more value, go to a lower valuation? Well, all of a sudden they don't meet this growth rate. We've seen it with Meta. We've seen it with NVIDIA. We've seen it with Teladoc Health. We've seen it with just basically there's actually more stocks that don't meet these year-over-year growth targets than are actually hitting them. We'd actually anticipate Snowflake to not meet those growth targets, to have their growth slow down at some point. That's why this would not be a stock I personally would recommend to most investors. But if you are the aggressive type, you want some high risk, high reward, this is a stock that you could play with. Just understand your risk. Understand it is a very high risk, high reward type stock. And if you like those types of things, Snowflake does check a lot of those boxes. It could eventually turn into a very, very wonderful long-term investment. It's just not there for me at the current time, but we'll keep following the story, because if this one does look like it's going to turn into a great long-term investment, that, my friends, is when you move in with a much larger margin of safety than what you're seeing today. Hopefully you guys enjoyed today's video. I'll be back again soon with lots more. Good luck with your investments.